Hello and welcome to another Hines Global Perspectives Forum. My name is Palmer Lettrich, Senior Managing Director here at Hines. I serve as the head of the Logistics and Industrial Platform here in the Southwest region. Today I'm pleased to serve as your moderator for our program, and thank you for taking the time to join us. We have a great conversation in store on the future of industrial and logistics, which we're calling Logistics and Leasing, COVID's Breakout Product Type. The focus of this morning's discussion will focus on the shift in today's logistics market as a result of the pandemic and what the group is seeing regarding shifts in tenant demand now and what we can expect in the coming years. We have a strong panel gathered from around the globe, so let me introduce them. Joining us from the Netherlands, Renee Buck is the Chief Executive Officer of BCI Global. Renee started in his company 35 years ago, and today BCI is one of the leading independent international site selection and supply chain design and consulting companies with offices in the US, Europe, and Asia. Ben Conwell is Senior Managing Director and Practice Leader for Cushman & Wakefield's e-commerce and electronic fulfillment specialty practice group for the Americas. Before joining Cushman in 2015, Ben was Director of North America Logistics for Amazon Fulfillment Services. Chris Bjorson joins us from JLL, where he serves as the International Director of Industrial Brokerage for the Americas. He's responsible for the development and management of the Retail E-commerce Distribution Group and member of the Global Industrial Board for JLL. And finally, my colleague Logan Smith is Head of Logistics for Hines in Europe. Logan oversees our pan-European logistics platform, and prior to joining Hines, spent 20 years in the logistics sector with such companies as Prologis and BNP Paribas Real Estate Group. Welcome to all of our panelists. Since Jerry Hines founded our company in 1957, the logistics and industrial sector has played a key role in our growth and success. In fact, the first building Jerry developed was a small office warehouse in Houston, Texas. Since then, the firm has developed or acquired over 73 million square feet of logistics and industrial space around the globe. As we all know, COVID-19 served as an accelerator for trends across the industry, such as expansion of e-commerce, the merger of industrial and retail, as well as effects on international trade, including nearshoring and reshoring. Today, we're talking about these trends and where it could go over the next 5 years. More specifically, what is driving tenant demand today and what the implications are for investment in the logistics sector over the coming years. As a quick note to our audience, we have set aside 15 minutes at the end of the panel for questions. Please use your Q&A button at the bottom of your Zoom screen to submit your questions as we go. We look forward to answering them a little bit later. So with that, I will open the forum with our participants. I'd like to set the stage for today's logistics environment by asking you, Renee, to provide a brief summary of how supply chains were affected over the past 6 months due to the pandemic.
Hey, Palmer, good morning. Thank you for having me. Yeah, I think if you look to how global supply chains were impacted by COVID-19, there are a couple of elements which have become more clear than ever before. One is the dependency on China. Now, we all knew that because so many American and European companies set up manufacturing plants in China to benefit from the low production cost there. But that dependency in having so much sourcing coming from one country, that has also led to the question, hey, if something happens, what is then our supply chain looks like? And that's exactly what happened. So that dependency on China has been very clear. Also in combination with the objective of so many companies to reduce their inventory. So the combination of being dependent on one country and on the other hand, having short lead times, that means also that if something happens and a disruption like COVID-19 happens, then nearly all global value chains fall apart. I think it also, a second element which we have seen that company now also once again saw the complexity of the value chain. You know, if you take a computer and if you look where that computer gets products from all over the world, even products and computers built in China, they get products from sometimes in South America, North America, Mexico, and then flown back to China for final assembly. So the complexity is a second element, which is also where companies are looking for new answers. And that complexity has also to do with visibility. We did last year already a survey pre-corona where we asked supply chain leaders, what is really important for you in 2020? And it was visibility of our supply chain. So not only knowing who are your suppliers, but also the suppliers of the suppliers, or suppliers of the suppliers of your suppliers. Because if you make a product and you miss a couple of components, and the products cannot be finished. So complexity in combination with visibility. And then I think we have, as a third element, is demand shock. And that has two elements. One is obviously the growth in e-commerce, and I'm sure we will talk about that later during the session. But obviously there are also sectors of industry which have really very difficult times. So that complexity and dependency of our value chains makes that companies are rethinking how we can do that. And I think they are looking for de-risking their supply chain in sourcing. So, hey, can we find in North America a supplier instead of getting that product out of Malaysia? Secondly, in distribution, should we not decentralize our distribution, have more local inventory so that we are not immediately out of stock if a disruption like COVID-19 happens? And the third element is more on the manufacturing footprint. There's a lot of discussion about reshoring, so companies deciding to bring manufacturing capacity back from China/Asia to North America or to Europe. And that's certainly also an element which accelerated, I would say, by the trade tariffs the United States is imposing on products coming out of China. So the dependency on China, the complexity of the value chains with low visibility, and the demand shock in various industries has led companies to review what should we do with our sourcing, what should we do with our distribution network and with manufacturing. And the question for many companies is, do we do that closer to our home markets, or do we keep that at relatively low cost locations in Asia, but then nothing should be happening?
So take into account some of those macro effects that Renee's talking about, Chris. You work with some of the largest occupiers in the U.S. And speaking directly to tenant and industry behavior here across the United States, who are today's largest occupiers, and how have their requirements that you're working on changed over the past 6 to 9 months?
Yeah, great question. You know, being from Ohio, you know, I felt that we were on this 10-year roller coaster, you know, at Cedar Point. And in 2019, I was reaching the top of that roller coaster. And then the pandemic hit, and we keep on going up. And so it's very unique. You know, JLL came out midsummer and predicted another 1 billion square feet of industrial absorption in the US by 2025. And that tenant mix keeps on growing. You know, when you think about that 1 billion square feet over the next 5 years, a predominant amount, probably 50%, will be e-commerce related. Not all B2C, we're seeing more B2B mix come into it. As we all know, the food and beverage industry has been extremely strong. So food and beverage continues to be a strong part of that mix. And as Renee mentioned, you know, there's a reshoring component, that reshoring and manufacturing of all different types of manufacturing is coming back into that mix. And the unique thing about that initiative is whether it's, you know, true reshoring efforts or it's manufacturing with distribution, you know, those size of those users are getting bigger. And so we went historically seeing those users in that 250 to 500,000 square foot chunk. You know, they've bumped it up. You know, they're adding a little more complexity. They're adding more assembly. You know, that's a 500,000 square feet to 1 million square foot deal now. And so that's a trend that we've really seen coming. So there's a whole mix of things coming that you know we're going to expect to see over the next 5 years.
And so let's unpack that just for a second. Aside from the requirements getting bigger, which, you know, we're seeing in key markets like Dallas and Phoenix, for example, what matters most, Chris, to today's top occupiers?
Yeah, you know, you're seeing a mix of all this. You know, I think the one advisement we give to all sort of development, you know, and owners is, you know, how do we create more parking, right? So when you look at your industrial lot, just about every one of our clients, whether it's from the truck and the flow of trucks or it's from the people and density of people, it seems like, a lot of spec developments are just short on parking and what the requirements look like. So I always encourage everybody to think differently about their building coverage ratios and what's really coming down the pike for utilization of that building. The second is really utility infrastructure. I mentioned some of these requirements that are now coming to what we would historically believe is the bulk distribution space, 500,000 square feet to 1.5 million square feet. Now, the bigger manufacturing, production, food and beverage type companies are taking down those spaces. And guess what? They need more power. They need more gas. They need more water and wastewater. They need more utility infrastructure to strike those deals. And so those are two of the biggest things that we're really challenging people, is that parking and that flow and the real utility infrastructure to make these deals above 500,000 square feet.
Yeah, and it's interesting you mentioned the 1.2 million. It seems like the million foot development that we have done and successfully executed, we're seeing requirements that are in excess of that. So going to 1.2, 1.3 now is not so rare. That's an interesting point.
Yeah,
Renee,
our trend line on that is, we're working on 2.5 million to 3.5 million square foot deals. But the trend line from your standpoint is the desire to lease is bumped up from your 1.2 Palmer to probably 1.5. When we're getting north of 1.5 million, for whatever dollar you're spending on the real property, that client's spending $2 to $3 a square foot inside the box. So in those situations, yeah, you may be a great situation for you to be a land seller, but those type of people making that type of investment typically want to be an owner.
Right. Renee, same question to you. Looking at the pandemic, how has demand and user needs changed from a supply chain perspective, both in requirements and geography? And what do you see as the implications?
I think what a lot of supply chain leaders and vice presidents, operations in international leading firms are looking for is de-risking and is building resilience. And one of the ways from a supply chain perspective is building more inventory. And it's not without reason that we see nearly all over the world that logistics real estate is doing great. And say in itself, also in comparison with other asset classes. So that's an important element. What we see on the production side is that de-risking means for companies who have manufacturing plants in China, hey, should we not adopt what we call the China +1 strategy? So setting up a manufacturing plant or multiple manufacturing plants in Southeast Asia, think about Malaysia and Vietnam and Thailand. We see companies considering to bring decentralized production to Europe, but even more, or even certainly more in the US. We see the reshoring trend. Chris was talking about more in the US today than in Europe. And one of the reasons actually is the trade tariff war between US and China, because if you have a product and you import it into the US and it's imposed a 25% import tariff, that means that the overall production costs, which are overall still lower in China in comparison with the US, certainly if you would take the central and the western and the southwestern part of China, and not particularly the East Coast, which everybody knows, then there is a cost advantage still, let's say, for China, but that is to a large extent bridged, traded off by import duty. So that whole reshoring trend is also accelerated by these trade tariffs. And then the question is, will they stay there? Because that would be a strong stimulus for reshoring. And there are people who think that the trade tariffs will be over if we have potentially a new administration in Washington early next year. I don't believe that personally. I think that the trade tensions between China and the US will stay for another 5 to 10 years. So yes, a process and tone of voice might change if we have another president than the current one in the White House. But it's a clash between economic system. It's a clash about technology leadership. It's not about buying more soybeans in the Midwest. And I think that that is a battle which will go on for a number of years. So if companies make the calculation, should we decentralize our supply chain? Should we reassure? Then they calculate, they incorporate in their calculations the trade tariff impacts, because they are probably not over, or now certainly not over by Christmas, but I think for a number of years to go. So basically, if you decentralize supply chain, you need more space. It starts with decentralization of distribution, so building a higher inventory level so that you're not immediately, there is not immediately trouble in paradise if something happens, and we are talking now about COVID-19. But let's not forget, we had also tsunamis and we have the earthquakes. So there are more disasters which can disturb your supply chain. So you see companies shifting from just in time to just in case. And for just in time, you need low inventory levels. For just in case, you just need higher ones. And that's a positive factor for what companies are looking for in logistics real estate. So that demand is up. And certainly what Chris was alluding to, that the sizes go up. And let's say what we call mega distribution centers, wherever you put the bar, that's something we see. And it has to do, on the one hand, with e-commerce, which just needs more space because the requirements there for handling returns and a larger number of SKUs in the warehouse. But we see it also in other sectors of industry because companies want to be not embarrassed anymore by running so quickly out of stock as we have seen in the first 2 quarters of this year.
Well, both what you're saying, Renee, and what Chris is alluding to are larger format buildings and factors that go toward larger requirements and more requirements, whether that's from decentralization or increased safety stock, like you mentioned. But you also touched on the elephant in the room, which is e-commerce. So, you know, we all know the storyline, which is the percentage of retail sales that was e-commerce was 11 to 12% before the pandemic. Now it's closer to 30% with e-commerce transactions, leases in the United States accounting for almost half of industrial absorption. So Ben, as Cushman's resident expert, do you see these e-commerce penetration changes as permanent? And said differently, is e-commerce going to plateau, or is this the beginning of another shift in the paradigm?
Yeah, well, Palmer, that's the $700 billion question here in the U.S. Look, these are remarkable times. All of us on the call, I think, recognize that so many of what we used to hold as absolute truth in our industry, in the real estate side, in the logistics operations side, and so much of that has now been turned completely on its head. And so many of the conversations that we're having with clients today, occupier clients, feel very differently than they did 2 years ago, let alone what has happened in the last 9 or 10 months it's COVID related. As you point out, depending upon how you measure it, yes, online retail, direct to consumer, is pushing either the low teens or the mid-teens going into COVID. And we were seeing that very steady progression, that very steady increase in share, married up with a very steady growth rate of online retail sales here in the States. That in spite of its massive size, the law of significant numbers has not really been in play. It's been growing very consistently, 15, 16 some odd % a year. And then lo and behold, the world blew up earlier this year, and we saw this remarkable spike up in terms of share. We can all identify with this. We were all contributors and continue to be in the way we shop and the way we interact with our retail, our retailers, as well as our wholesale vendors. And yes, we've seen that more than double in terms of share. In the second quarter of this year, you know, as we calculated, even above 30% share. Now, my crystal ball is pretty good, but it's not perfect. When we look at where are we going to stabilize, where are we going to, quote, normalize, whatever normal is going to look like, it's a pretty safe bet to say that share is going to normalize somewhere between 30 and 15%, right? We've probably bracketed the high and the low. We've collared it. But there are some verticals within the e-commerce world that will continue to grow much faster and be greater than a 30% share. I mean, some of those verticals we know, sure, general merchandise, you know, the general value retailers, home furnishings, home improvement, and goodness knows pharma is going to continue to explode in terms of online delivery. So we know those are going to be leading the pack as they have beginning earlier this year. Where exactly that share industry-wide is going to normalize, that's a tough bet to make. I think it's at least a high I think it's probably got a 4 handle on it here over the next couple of years. And if there's one characteristic in all of our projections over the last couple of years is we've been wrong, and we've been wrong on the low side. So these are remarkable times, more disruption to come. And goodness knows we've seen these huge surges in demand, not only in the verticals I described, but if we have time to talk about grocery and online, that's another remarkable driver. Potential upside is huge for the growth in online. So ask me in 4 or 5 years, and we'll have an even more confident answer.
Right. Well, let's talk about that for a second as far as what's happening in 4 or 5 years. Logan, taking into account what everybody said here, what do you see as the most relevant changes to what you encounter on a daily basis, and what does that imply for the next 3 to 5 years?
Yeah, thanks, Palmer. That's I'm giving some thought to what I'm hearing from the panelists here, and Ben. No matter whether it's between 15% or 30% or 40%, as the saying goes, the making predictions are difficult, especially about the future. But whatever it's going to be, it's going to be higher than what it is now. And when we look at Europe, Palmer, I'm struck by everything I hear all of my fellow panelists saying here. And against that context, remember, even before COVID, the warehouse space per capita in Europe was only about 1/3 of the level that it is in North America. So as I hear Chris talking about Jones Lang increasing their estimate by, 1 billion square feet per year, or 1 billion square feet total through 2025, if that's for the US, the number for Europe clearly suggests to me that there's a lot of growth to go. So clearly, as with Europe, as everywhere, we've seen 3 years of e-commerce growth in about 3 months in more or less every European market. But I think what's interesting about it too is if you think about where we are with this and whether we're at the end of something or the start of something, I firmly believe we're at the start of a secular change on this. And to Ben's point again, even if e-commerce is going to increase still in the US, it's doubly the case, certainly in Europe. And I think that another point too is that the industry has been really undershot leasing projections more or less for the last 15 years. This is nothing new. And if you go back to 2008, 2009 timeframe, the expectation was that a lot of the spec buildings that had been built would remain vacant forever. But lo and behold, the logistics real estate industry undershot the expectations of e-commerce leasing growth. And lo and behold, 3 years later, all of these buildings were leased. A lot of this same trend continues to occur. And I think that part of the reason why this might be is we tend to look at real estate, logistics real estate specifically, in a little bit of a vacuum. We're all fairly aware that larger e-commerce, larger technology trends are driving this and driving the design and the usage of the buildings, et cetera. But when you take a step back and compare the relative industries here, I had a little statistic that I put together. If you combine the market capitalizations of some of the larger companies in the logistics space, so combine the market cap of Blackstone, the entire organization, Prologis, GLP, Segro together, you get to about 150 billion US of market cap. That is less than 1/10 the size of Amazon. Now, if we talk about Amazon taking 25 to 50% of absorption in the space, they're not the only one. There's plenty of companies behind Amazon that are just as capable and just as willing to invest and to make an impact in fulfillment and distribution, and consequently logistics warehouses as well. I'm thinking of Alibaba, for example, DHL, Microsoft, FedEx just put together a partnership in the US, and even Google and Facebook have been talking about it. And each of these companies are many, many times the entire size of our entire industry put together. So to the extent that logistics warehouses are just one little piece of infrastructure within a much broader trend right here, it suggests that there is going to be a real inelasticity of demand going forward, and that what we're looking at is as much supply chain infrastructure as it is real estate. So when you take a step back and think about it, against everything that I've heard here on this panel, I think that we'll be having, as Ben said, the same conversation in 5 years, and we'll be talking about whether the trend has run its course yet. Now, that doesn't mean that no investments are bad investments. That doesn't mean that everything is good, but clearly there's some real drivers for growth here that I think are unique to our sector that you don't really see in a lot of other areas to invest.
That's a great point, and I see this in our different markets as far as where each market is with regard to that trend and specific to e-commerce. And I would tell you that, for example, in Mexico City, for example, or Guadalajara in Mexico, we're seeing some tenants that are benefiting from the activity that Renee's mentioning, and then you've got they're very early on the e-commerce penetration. So you look across the industry and across the geography, and you can see these trends manifesting themselves very differently, but they all feel like they are on the beginning of something rather than the end. Let's talk about the tenant side of the equation for a second, and I want to get into the future of the logistics space a little bit. I'm going to frame this by reading from a brief snippet from the Rethinking Real Estate book that one of my investor partners gave me. And it has a paragraph in here that says, compared to other commercial uses, industrial properties have so far retained the classical characteristics that institutional investors know and love: simple and fast construction cycles, low upfront investment, low re-tenanting costs, and healthy demand from occupiers that sign long leases and pay on time. These days, industrial assets also enjoy higher liquidity, making them easier to acquire and exit. So looking to the next 3 to 5 years, does logistics continue to represent the stable investment in the future that it does today? And really what I'm getting to is the continuity of cash flow. So Chris, and then I'll ask Ben, what are you guys seeing as far as specifically what the industry's largest tenants are attracted to, and what are they demanding?
Yeah, great question. You know, I think Logan framed it up that you see sort of tiers moving on, right? So, you know, a lot of the Fortune 100 clients, you know, have fulfilled their first mile, mid-mile, and really working on the smaller footprints right now on the last mile installations, whereas the Fortune 100 to 500 are still in that first mile and mid-mile. So you're seeing big deals out of that. And then, you know, behind that, you know, beyond the Fortune 500, they're all in between. And a lot of those people are using 3PLs and other groups, you know, to fill all the sectors. You know, but we still continue to see the trend line strong. The one thing you have to take into strong consideration is when you think about location, we're just not talking about real estate. Someone's already checked the logistics box that we can justify location, but often we're getting challenged extremely hard on the labor. And so you're seeing, when I talk about the investment inside of the buildings being 2 to 3x what your real property investment is, that's simply in the most part to control the labor environment. And so I see more risk of buildings being empty in the next 5 years because you cannot produce a cost-effective, sustainable workforce in the buildings you've decided to build, because that's becoming more and more. Our clients are saying labor, logistics, location. And if we can solve the labor equation, I don't care how good of a quality Class A asset you've built for any of those size ranges, if we can't solve it, we're not coming. So I think that's something more and more we have to start getting in tune with each other is how is these workforce markets and communities supporting the industrial growth that we see.
And I would echo that. Just in we signed a 1 million square foot lease recently in Dallas, and the tenant, the first thing they were doing was the labor analysis to understand if that building was going to work, which it did. So and that's an e-commerce related use. So Ben, what are you, aside from labor, and maybe talk about the importance of labor and other factors that drive that decision as far as what you see?
Sure. And to dovetail with Chris, your comments, 3+ years ago, with our institutional investor clients and our developer clients especially, I would be jumping up on the table. The first thing that I wanted to communicate to developers looking to underwrite major commitments for logistics development was labor, because heretofore, few developers really got religion on how important that was, and they didn't really appreciate the make or break, as Chris, you point out, go or no go from their target occupier customers. We fast forward to today, and I'm sure everyone on the phone call here is smart enough to recognize in underwriting new development, you need to be underwriting the labor risk, the labor availability and sustainability every bit as much so as you do geotechnical or environmental risk. It absolutely is that important. Two, as we see these major online retailers gobble up space in markets that a few years ago we used to call secondary, goodness, heaven forbid, we call some of them tertiary, which is not the most complimentary, we know. That math also has really been turned on its head as these major players and even the mid-market and fast-growing emerging e-com players, the world is much more broad, and the markets of interest and markets of consideration is much more broad than it is today. And then lastly, we talk about, yes, there's this massive projected demand for new space because of the unusual characteristics of online fulfillment. Well, the fact is, we're all now about speed, right? Everybody in the old days of catalog fulfillment could get by with a distribution center in Chicago, and maybe if they were very sophisticated, they'd have one in Los Angeles. And 7 or 10 or 14-day delivery was an okay thing. And then our friends here in Seattle built their network modeled primarily on a 2-day ground proposition. Build that network so you can deliver 2-day ground. And that delivery proposition, as we all know, has done nothing but further compress. Now it's about next day, and increasingly it is, and sure will continue to be, all about same-day delivery. And you can't do that with 2 DCs. Goodness knows you can barely do it with dozens and dozens of FCs across the country, tying back then to target markets. To do that, to be close to consumers, you've got to be developing footprint in a lot of markets that we weren't having conversations about just a few years ago.
And what you're saying there, Ben, is almost like what Renee was saying as far as decentralization and expansion of the distribution network. So touching on labor and then touching on access to urban density, I'll ask you, Ben, and maybe this is for anyone else on the panel, but that then opens the discussion for retail and conversion of retail to industrial. And the $1 million question there is, and I spend a lot of time doing this. We have 2 of them right now that we're underwriting and getting close on. But the challenge with that is, depending on some of the other ones that we've simply rejected because the lease rates have to be so high for that product to work. Ben, will your logistics users pay more for those types of locations? Whereas before, the big industrial logistics users have simply chased the lowest lease rate and been happy going to the next exit.
Well, chasing the lowest lease rate is an interesting hypothesis. All of us in the real estate industry, especially in logistics, we think that the sun rises and sets for these occupiers around real estate cost and lease rates. And the fact of the matter is, occupancy costs, lease rates, is a very small slice of the overall expense stack for running a building, let alone running a full network. So we need to take ourselves down a couple of pegs here. Every one of our clients, and I know it's the same way with Chris, when faced with an opportunity to pay, say, X to be deep embedded in urban areas, to be in Brooklyn, to be in Queens, or to be on Staten Island, and to pay X, where I can serve this massive population and maybe turn my delivery vehicles 2 times, maybe even a 3rd time. You have to weigh that against, for instance, being halfway down the turnpike in New Jersey, where I'm paying maybe a 1/3 of X, 1/3 of what it is in the boroughs, or at least half of what it is. But I can't serve the target community as efficiently. That is, as many turns on my vehicles, as predictable delivery times. And every one of our clients has a different set of calculus. So we can't generalize simply to say being closer in is the single variable and it's the single dimension. It's much more complex. Many will take that option A, many will take option B. So lease rates are only a small part of the overall picture. It's much more complex.
Yeah, Palmer, and our clients are challenging us. They're deciding a dot on the map. They're analyzing total cost of ownership. That's transportation, workforce. That's all the pieces of the puzzle, tax structures. So they're driving us to have a total landed cost on those deliveries. So the client's not just focused on industrially zoned properties. If there's a retail conversion out there, if there's a office building conversion out there, if there's any of those conversions, they expect to see it. And so that whole world of client demanding, and they may wait for a retail conversion. That whole world has changed everything that we're doing in this last mile and created what we believe, coming back to this 1 billion square foot projection, we think there's an opportunity for about 50 million square feet of retail to industrial conversions to happen. And that's just because it happens to be located in the right way. But Palmer, as you're seeing, that comes with challenges. There's no layups out there in that business. So from rezoning, from the tax structure differentiation, all that, there's just not layups out there. So, but that's going to happen. They're in the right place. It's just not the right asset. And it's going to happen. In our opinion, that conversion is going to happen.
Logan, are you seeing that in Europe? And specifically, how do you see warehousing changing over the next few years?
Yeah, there have been a couple of conversions. I don't think there's been quite as many as we've seen yet in the US. They tend to be limited to higher land value markets like Paris and London, but you do see more thoughtfulness around it in other markets for sure. But I'm struck with this conversation of how warehouses are changing, because they've always changed. I think one thing that's been really the situation for the past few years is there's been a proliferation of subtypes of warehouse. When we talk about multi-story, for example, we can mean a number of different things. It can be a multi-story ground plus 4 Amazon facility that uses automated robots inside. It can be multi-tenanted drive-up facility. It can be ASRS, automated storage and retrieval systems, all of which are new and potentially very viable from a supply chain standpoint and maybe from a real estate standpoint as well. And I think the same applies to last mile, right? Last mile is the one aspect now that we've talked about a little bit on this panel. Most investors have a general sense of what it is, but there's still not that much consensus as an industry about what we mean by last mile. Anything can be last mile, really. In fact, some of the best examples of last mile facilities out there are smaller trade users that might have been doing exactly the same thing in the space for the last 30 years. The only difference is now they have real estate people knocking on their door, telling them that they're all of a sudden last mile, right? So there's certainly a lot of changes happening. And I have a picture I wanted to share with you as well. Palmer, you gave me this idea before we mentioned it. Let me see if I can manage this. Bear with me. Now these are two warehouses here. On the right, you can probably see is a conventional newish Amazon warehouse. And on the left is the warehouse Palmer mentioned at the start of his comment. So it's a special warehouse to us. And this is the warehouse that Mr. Hines developed in either 1953 or 1957, I believe. I'm not exactly sure of the year, but in any case, it was about 40 years before anyone ever heard of A&B or Security Capital or Trammell Crow or any of this even became accepted as an institutional property class. So, and if you look at them, what struck me wasn't so much the differences between them, but the similarities. You can see in both cases they have efficient use of vertical space, right? You have racking. In both situations, you have a guy in the back using a pallet truck, whereas on the Amazon warehouse, you have much more sophisticated conveyor systems in place. But I think more than anything, what struck me about it was the story that I had come across when I heard about this. And I've only been here at Hines for a few months, right? But the story at Hines with this warehouse was that in the early mid 50s, when Mr. Hines was getting his start, he had a friend of his in Houston who had a booming business and oil supplies and lubricants, et cetera. And there was no one to build him warehouses because no one built warehouses then. And he simply put his hand up and said, well, hey, I'm an architect, I'm a developer, I know how to do this. And lo and behold, he managed to get the money together and build a warehouse, and there you have the picture on the left. But what strikes me about that is you think about how some of the good developers, how some of the good e-commerce companies position themselves. Again, it's that customer responsiveness. And I think that's one thing that we have to be careful not to lose sight of in this, because we're here on this panel trying to figure it out exactly what's it going to look like in a few years. Well, it's that same responsiveness to partners and customers that are going to drive the next trend of whatever it is. And there could be 5 or 6 different good answers to this. There's not the 1.2 million square foot warehouse in a suburban area could be a fantastic investment and sit perfectly well in a portfolio alongside a portfolio of smaller, older infill distribution facilities at the same time. So I think we have to be prepared for this. We have to be prepared for this level of thoughtfulness and nuance as we move ahead. And at Hines, we're fortunate enough to have experienced teams on the ground who've been doing this, who've been working with cities, doing planning, doing urban development in warehouses, some, yes, but also in other property types for quite a long time. So this is how we're positioning going forward and how I personally see warehousing evolving into the future.
Yeah, Logan, what's unique about the last mile is the other alternative users that have really shown up. I mean, we have profiled it as last mile, but we have made last mile rents from storage companies, from advanced manufacturers, from technical training colleges. And so space that was classified as last mile or urban industrial, there has been industrial type usage show up, but there's plenty of people willing to pay that type of rent that you're not underwriting for. So, I challenge where you're going, Logan, is think outside the box, because just getting it classified back over to industrial is opening up a whole different area for many property owners.
That's a lot that we're saying there as far as what the implications are and where this is all going. I want to ask one last question, and then I'll get into the Q&A from the audience. And I'd like everybody's thoughts on this, and I'll probably start with Renee. So if we condense everything that we've said over the last 45 minutes, in your mind, what is the single most impactful change to the logistics landscape that we've seen as a result of the pandemic?
I pick on the word Chris was using, total cost of ownership. So I think companies are more and more aware of the total landed cost of your products, wherever you produce it, wherever you distribute it, whatever you calculate in your calculations, whether it's operating cost, do you include in your total cost of operations, do you include, for example, a once in the 5-year lockdown of 2 months, or what is the check you have to pay for that? So I think looking to total landed cost, in looking into how you set up your supply chain, that's an important element. And if I may add one element to that as well, is that I think if you, as we talked also about reshoring, it has not only to do with labor, which is an important element, certainly also in Europe, but it has also to do with the ecosystem of suppliers. You know, if you take a ventilator, there was a lack of ventilators for IC units all over the world, right? Now, in a ventilator, you have 400 components. You can bring the final assembly of that ventilator to Tennessee, okay, and you produce in that facility, say, 100 components. Then you're still very depending on where these other 300 components are coming from. So in the idea of how companies run their supply chains, total landed cost, if you're thinking about production or final assembly, think also about the supplier ecosystems, are they available? And secondly, about the labor force, which was also by Ben and Chris alluded to.
That's great. Ben, Chris, Logan, one single greatest impact that we've seen and how that plays forward?
Wow, real estate guys who are hesitant. I'll plunge in. I confess my bias as I come to the conversation, but I'd say the biggest, the most significant disruptor change here has been not only those of us who have been active online customers in the past, we're buying more. So that's one dimension. The other dimension is, as a result of COVID, the breadth, the width, the variety of demographics who have tried online maybe for the first time and are going to be repeat active customers. So moving in two dimensions, we're buying more and more of us are buying more online.
I think as a disruptor, Palmer, in terms of our industry, it's I feel like this is the first time that logistics real estate is seen as a type of infrastructure of a city, of an urban environment, not so much as a real estate property class. And it's a little bit new for us, right? We're not so comfortable with the spotlight. We're trying to figure out exactly what that means, but it's led to a lot of additional interest and capital into the sector. And I think that there will be consequences to that as well as we continue to think through it. On net, I believe it's a good thing, but it definitely has been a change.
So I'll pivot over to some of the questions in the last few minutes that we have. And Ben, this one seems like it goes to you. With so much failed retail and fewer retailers in general right now, does that mean higher vacancy rates and lower demand? Is there a risk of that?
This is a question I get very, very often, and I'm sure most all of us on the call do as well. But our house view at Cushman & Wakefield, and it happens to be mine as well, is at the same time we're seeing the number of failed and failing retailers reach historic levels. We have this massive, ever accelerating engine with a seemingly insatiable appetite for space. So we project, there'll be some frothiness here in the very near term, but I think the prognosticators that say we're going to see any kind of significant upset in vacancy and hence in lease rates, that just does not jive with the way we see the data today. We don't expect to see any significant needle movement in vacancy, generalizing nationally. We're so very fortunate as an industry and as a product type to have this very, very powerful engine looking to absorb space as it becomes available.
Somehow I knew the e-commerce guy was going to have that answer.
And I hope I didn't disappoint you. That's good.
Chris, talking about tenant behavior, one of the questions is on automation. So how does automation figure in your clients' use of their buildings and how they view their choice of locations of buildings?
Yeah, I think automation, as I said early on, automation comes with the right power infrastructure. So, automation is, so there's two things that are happening with automation as you are putting up buildings. And we still believe, as Ben was saying, demand is going to outpace supply. So you're not putting up buildings fast enough, and the ones that you're putting up may not be exactly right. Because what we're seeing is we need power, and that power in some markets is 6 to 12 months to get the next 5,000 of amps of power in that building. So you're immediately cut out if you don't have enough power in a building. The other thing is we typically are hanging, to increase automation, we got to use the steel structure. So we got to hang stuff from the roof. And so if you've not planned for that building to support at a minimum HVAC, and next level supporting some type of hanging conveyor, you're going to miss some significant opportunities there too. So a lot of moving parts coming into when we talk about automation of what can you be doing better as a developer to support in winning those deals.
Mm-hmm. Mm-hmm. And one of the other questions that we just got was related to the physical asset. And Logan, you mentioned that there's different kinds of last mile. So the question is, can last mile work within existing building heights, and how does last mile look, and what does it need in these various infill locations?
Yeah, I mean, we could talk for 30 minutes on this alone, but I think the simple answer is yes, it can. And last mile is also changing, right? What Amazon means by last mile from a ground plus floor facility is very different from what a plumbing supplies company that's been operating in a small space since 1975 means by last mile. Both of them need to be last mile, but it's more location driven. So if I were looking at it from an investment standpoint, I would really just keep it simple. Just buy good buildings. By good, I mean functional buildings in good locations at reasonable prices, and with thoughtfulness and awareness to what the future use of the building might be. You won't get it perfect, but you can project enough to have a good scenario or two about how to underwrite it and how to value it.
Mm-hmm. I mean, a lot of what we're saying here is that for safety stock, for decentralization, for new buildings, for all of these trends, we are leaning into things are going to get more demanded, and things could get more expensive. And some of what we're saying is that the real estate, the occupancy cost isn't that big of a factor for these tenants and occupiers, whether it's on the supply chain side or just on the occupancy side, which kind of leads over into opportunities for rent growth. And so I would, I'll just throw this out as a general comment. Are occupiers, have they been seeing this over the past few months, and are they looking down the road and understanding that there's going to be some benefits associated with it, but there's also going to be potentially some added cost? Renee, are your clients seeing that?
I think they just have to accept it as fact of life. It's we see that you could have imagined that with the let's say with the economy decreasing by 6 to 10% wherever in the world, that logistics activities would go the same level down, and that would not have a positive impact on rent levels from an investor point of view. But nearly the opposite occurred. Let's say the logistics has been one of the most resilient industry verticals. If you take all the verticals in the economic structure in whatever country into account, that means that everybody sees that, and tenants will see that as well. That they see that there is a big appetite for logistics real estate due to these higher inventory levels, due to what Ben and Chris alluded to on the e-commerce side. But also that supply is not that huge. And if I can give a European perspective, which is probably in a sense different than the American one, in Europe, we see that the public opinion is not always in favor of large logistics real estate. They see it as big boxes piling up in the landscape, sometimes even due to their height. So not only the size, but also height up to 25, 30 meters. So the public opinion in many countries, and I think Lowen can confirm that, is not very positive about logistics real estate. So on the one hand, we have increasing demand, also with the drivers we discussed in this forum. And on the other hand, we have not much of a great added supply to that. So that means, economy lesson number one, demand is up, supply is not on the same pace, rents will go up.
Yeah, and Palmer, as you can appreciate, it's just, educating the client on where the market's going is different than educating the client on the speed it takes to get a deal done. And so that's the disconnect right now. I think the client's seeing where the market's going, but that doesn't mean they have yet changed their internal process, approvals, board approvals, to get deals done fast enough to actually make that first deal. So unfortunately, we've been in the world, especially from the pandemic, of not, right or wrong, making the second or third deal instead of making the first deal, because corporate America is realizing how fast everything's moving now, and it takes one or two times to figure it out.
Mm-hmm. Chris, we saw in the last couple of months, I don't know whether that's your experience as well, that let's say, I would say till July, it was like everybody was just wait and see and what will happen the next 12 months. We saw the last 2 or 3 months among our American clients and also our international clients doing business in North America, the conviction growing, hey, we cannot just wait till it's over because we know that it will not be over in a couple of months' time. So we have to act. So actually, while also in our practice around the world, in April and May, everybody was postponing decisions and just let's wait for new initiatives, that the last couple of months, it actually accelerated because everybody knows or feels that you just cannot wait till we have a working vaccine. That's just not good enough for the C-level.
Mm-hmm. Yeah, Renee, who thought, that Q4 2019, it could get better. But then we saw Q2 2020 get better, and we expect when these numbers come out on Q3 to be better. And it forces everybody to sort of raise the game and speed to market and speed to execution and properly move forward together.
True.
Well, that's good. That's a good summary. I think that I've got to get to work, and I know you guys do after this panel and after everything we're saying. So I want to thank you all of our panelists for your time today and for the expertise that you've shared. And thank you to all of our participants. I will mention that if you're interested in viewing past sessions of the Global Perspective Forums, you'll find them on Hines.com. So with that, I will wrap up, and thanks again.